How are you feeling about Apple these days?
Good morning. Look, I think it's a great company, but what I am concerned about is that you have a multiple that went from 12 to almost 30. So phenomenal company, great cash flows, but it's a classic stay-at-home story, and I wonder at times this multiple can contract. Doesn't mean that the earnings can't expand. It's just a question of how far can you go with that multiple.
But that's the question for all these stay-at-home stocks. What is a fair multiple to put on these companies on a long-term, arguably sustainable basis in a somewhat, we'll describe it as post-pandemic world? Clearly, we're not there yet, but you have to hope 12 months from now that we're closer.
Right. So, Andrew, I would look at some of these companies. Take an Apple, for an example. Think of it more as a consumer staple company. This is going to have recurring revenues. It's going to have demand. And most consumer staple companies trade for 18 to 20 times earnings today. So that is based on kind of what we've seen historically. What also we would expect is post-pandemic reopening, money is going to flow to areas where there's going to be greater growth. Not to say Apple doesn't have good growth, but you're going to have higher growth in other secular growth stories, and capital would necessarily flow there. So a question I have is, how much do you want exposure to companies like Apple? It's a portfolio management question. It's a great company. You want to hold it, but you just want to make sure that the Apples, the Googles, the Facebooks of the world are not too big in your portfolio, because that will hurt you long term, even though they're growing their revenues.
How much of that thesis has anything to do with the idea that some sales, potentially, and we can debate it, have been pulled forward? Meaning, in a work-from-home environment, people are buying new laptops, they're buying new phones, they're buying new equipment to make it work today, and maybe that means they wouldn't upgrade a year or two from now.
I think quite a bit of that is built in already, and you've seen the demand for all these stay-at-home products really increase if we didn't have this a pandemic. So I think you have to build that into your financial models, and then going forward say, okay, when the consumer comes back, when businesses come back, where is that incremental dollar going to be spent? If we are open, is the consumer's going to do travel, they're going to do leisure, they're going to spend more money on themselves? Are they going to replace, their next iPhone? Same thing with businesses. I mean, so many businesses have upgraded all their systems, all the software, the cloud stocks. Again, these are great companies. What you're going to look at is the second derivative of growth. And that's going to be really important, because there are going to be other areas that we have just taken to go negative and have, ascribe zero value, whether it's in financials or it's energy or cyclicals. And what I think is opportunities are elsewhere, but you can't stay with these. Just do it in a prudent fashion.
Right. Do you think we're being too optimistic about a vaccine and what the world looks like in a post-vaccine world? Because in a weird way, there seems to have been a massive switch in the market, almost terminal, not I don't want to say terminal value, but as if the world really is back to normal at least a year from now. Obviously, we're all hoping and praying that that's the case. But then, you think about all of the challenges of distributing the vaccine, especially this Pfizer vaccine at these lower super cold temperatures. How efficacious it really will be over time. What the side effects really are. There are reports, obviously, that people do get fevers and think that it feels like a hangover, and so do people end up taking? I mean, there's lots of things that could happen between now and then. And how do you think about that?
So I think that's a really good question. And one of the ways that we're looking at is to say, look, you want to be barbelled, you want to be diversified. So if all of what you just described, works out, then you will get a lot of capital flowing out of all the growth stocks. But in the meantime, it's kind of like a hedge in your portfolio. These are the bond types of investments you want to have, but you still want to look, because I do believe that if it's not Pfizer, it will be Moderna, it'll be somebody else. We will have other people working on this. They are still working on this. And you do have the Fed behind this as well. I mean, we're going to have more money in the Fed. Fiscal stimulus at some point will come, and that will provide a bridge. So if it's not 6 months to 9 months, maybe it's a year, but I do think you want to be looking out long term. And again, if I was an investor today and I'm fully allocated and I'm over my allocation, pull back. We've had a great run. Take the money off the table. This is looking 3 to 5 years out. This is not for the next 6 months. It can be pretty volatile, and we've seen that over the last 6 months.
Shepard Smith here. Thanks for watching CNBC on YouTube.